We're going to be talking about the Federal Reserve raising interest rates by 0.75 again and how markets have responded since. Let's waste no time. Let's get right into the content today. Before we do my spiel, if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this and hit that thumbs up button for me. The Federal Reserve is on a mission right now to cool the economy. They are not playing. All guns are out and they are on a mission to cool the economy. And the biggest gun that they have in the arsenal is raising interest rates, making borrowing more expensive. And, unless you've been living under a rock recently, you know that the Federal Reserve has been raising interest rates. We've been seeing this happening, but it hasn't necessarily worked out as some might have planned. We've seen some pretty aggressive rate hikes, but then when the inflation data has followed it, it has still remained elevated, which has led to more aggressive rate hikes. And now at this point, we're starting to see, interest rates that we haven't seen in quite a while. And I do think that ultimately we will see a cooling of the economy, but I don't think that some of the key things that we want to see as consumers, prices go down or prices just stabilize in, I don't think that it will necessarily play out exactly how the Fed wants it to. Most importantly, the price of food and the price of energy consumption. So our electricity, our gas bills, the price of food, the things that we use on a daily basis. And the reason being is because those are a more dynamic situation than just interest rates. Now, you could raise interest rates. You can make borrowing more expensive. And at a certain point, people will stop spending as much. A lot of discretionary spending will go off the table. Prices will kind of stabilize in certain areas, but the production of food, the production of energy, those more dynamic areas, some of those things are out of the control of the Federal Reserve. And while I do think that, raising rates, cooling the economy does cool inflation, that this is a more dynamic situation than just those two facets would help you to see. Now, supply and demand is the key to stabilizing any market. It doesn't matter what that market is. And with these certain markets that we're discussing, food markets, energy markets, there's different things like, the production of fertilizer, how much fertilizer costs, which has a direct effect on the farms. And, I'll make further videos about this stuff moving forward, but I think that, we're not out of the woods yet. There's a lot of other things that need to kind of take place before things would go back to a normal that we might remember from a few years back. So knowing what the Federal Reserve is trying to accomplish, but also knowing that the situation is more dynamic than that, what comes next in this chess match? So what the Federal Reserve can do is make borrowing more expensive, and that is exactly what's going on right now. With interest rates going up, borrowing is becoming more expensive, and we're starting to see a little bit in the numbers, a lot of discretionary spending that people were making before, they're starting to pull back on it. So things like going out to eat, going to the movies, theaters, sporting event, vacations, things of that nature, that discretionary, that fun part of the budget, something that a lot of people, in this country typically put on a credit card. Some people leave it on a credit card when rates are low, when, things are in a investor friendly type of situation. Those things are okay, but where rates going up, uncertain times, people seeing their portfolio values kind of dwindle, you're starting to see borrowing get more expensive and discretionary spending kind of taking a backseat. The thing is, with all of that, borrowing can be more expensive, discretionary spending can go down, but the Federal Reserve doesn't control the supply of the type of prices that we want to see go down. So food prices at the grocery store, energy production. So the Federal Reserve doesn't control the supply and demand of food. They don't control the production of energy. Those things, as much as they can raise rates and they can do certain things to, cool off inflations, this is a more dynamic situation than just, Federal Reserve raising rates and prices going down. There are other factors in play, and I'm going to make further videos about this as well. Things like the cost of fertilizer production. I've talked about, just weather patterns and different things that we have going on right now that are really affecting the supply of food, a lot of geopolitical things that are negatively affecting energy production and energy prices. And these things are kind of moving back and forth. You see some increases, decreases. Ultimately, the Federal Reserve doesn't have as much of a control in these areas that are essential to our everyday spending as we would like them to have. So I do think that the Federal Reserve will eventually cool inflation, that the inflation numbers won't be 8, 9, 10%. They'll be closer to that 3, 4, hopefully 2, in that range. I do think that they're going to do that, but I think it's going to come with a great cost. So the word recession, you're going to start seeing it everywhere. I've been saying it, we're already in a recession, but you're going to start seeing things like job cuts. More and more companies are going to start to scale back. So job cuts, you're going to see, that discretionary spending kind of cool off, the economy kind of cool off in a more aggressive way, in a way that's going to be more pronounced, more visible for everybody to see. Recession, but I don't think that some of those things that we really care about, that really hit home, like food prices, energy production, energy prices, those things that we use on a daily, I don't think that they'll necessarily help with the decrease in prices in those key areas.